everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. All right, welcome back. Tajudeen Ibrahim, Director of Research and Strategy at Chapel Hill Denham, is joining me right now virtually. Good morning, Tajudeen, and welcome. Another inflation print. The last time we spoke, we talked about the CPI rebasing. Can you hear me?
Good morning.
Good morning. Yes. Now, let's get started. Talk to me about the slowing rate of inflation now that we have about 23% after the rebasing. Just speak to me about that, your reading of this print.
So what the reason of this inflation rate means is that we have much lower inflation rate recorded in the month of February to 23.18%, down from 24.48% level in January. And what this indicates is that we have disinflation in the economy based on the newly rebased consumer price index. And in terms of methodology, when we talk about the current inflation rate, what it means is that we are taking the composite price index level for the month of February 2025 and comparing it with the composite price index for the month of February 2024. So that comparison is what yielded 23.18% and points to the fact that, broadly speaking, the price levels in the economy are rising at a much lower rate based on the new methodology. That is what that number means. But we can have another view at the numbers when we consider what the National Bureau of Statistics calls the 12-month average inflation for the country. And that is when we are looking at inflation rate being 30% on average, precisely 30.09% on average for the month of February down to January of 2024. So 30% of 30.09% in February, to my mind, is more a reflection of what Nigeria inflation rate looks like, given the fact that prices, generally speaking, are rising at a much faster rate than what the 23.18% is depicting for us in the country. I think that is the way to view those numbers.
End is over, even as inflation is still high, because we shouldn't be maxed. Our faces shouldn't be maxed to say that inflation is down in the country. You understand what I mean? But even with that, is the deep end over? Are we beginning to go towards the shallow waters?
So, and that is the reason that I said that the best way for Nigerians to look at the inflation numbers for the month of February is to take a look at 12-month average. That is, take a look at February of this year, January of this year, and go 12 months back to March of 2024. From March 2024 down to February 2025, we have a 12-month period. And for the 12-month period, even with the rebasing, Nigeria's average inflation rate is 30.09%, which to my mind is more a reflection of what consumers in Nigeria, are seeing in terms of price increase. I believe that the authority and Nigerian citizens as a whole should not take off their eyes from the 12-month average. They should look at what has been happening on average over the past 12 months. That is when we have a full view of the impact of price movements in the economy instead of looking at it on a year-on-year basis where we just pick what the number was in February 2024 and what the number is in February 2025, neglecting what has happened in between those two periods. That is what the 12-month average inflation does. It does not neglect what happens each of the months in the past 12 months. It captures everything, and I reckon that given the rebasing, that is what we should be looking at as a country because it is more, of a reflection of our situation in the country in terms of the movement that we are seeing in the prices of goods and services in the country.
Do you?
So our faces should not be masked at
Yeah,
all.
yeah.
Our faces will be masked if we are looking at point on point alone. But
Okay.
when we are looking at the development over the past 12 months, everyone would be able to see, what the real numbers look like. And it is more of like 30% than 23%.
So Nigerians shouldn't buy the idea of inflation cooling off, temporary relief, because the temporary relief can also be attributed to perhaps exchange rate variable, to perhaps the fuel prices variable, which we've seen slow in the last 2 months. What else again is there as a variable that may have contributed? But at least these two important variables. So, but should we take it, we shouldn't take that idea that inflation is cooling off, cooling prices.
So, so there are two perspectives to it, and I think the first perspective is to look at it on a 12-month average. That is what I subscribe to because that is what will reflect, the
Tajudeen, I
true
heard you saying 12
situation.
months average, but what I'm coming up again is that an average Nigerian consumer, okay, let me put it that way. The Nigerian consumer shouldn't buy the idea. An average Nigerian consumer don't chew data as both of us do. How they interpret inflation is by prices in the market. So for you, you're checking out the 12 months data, you will look at it, but for others, that's not what they're seeing.
That's what I'm saying that, when everyone on the street understands that, on average, inflation in Nigeria is more like, 30% on average. And that is, more like what we are seeing, what Nigerian consumers are seeing. But I believe that, that is not what the authorities will be looking at to make economic decisions, what they'll be considering is the point-on-point change, and that is what is depicting a deceleration or disinflation in the economy. Now that we have it come down to 23.18% in the month of February from about 24.48% in the month of January, the implication is that the monetary policy rate, for instance, has now become more positive
Yeah.
on a real basis, in real terms. Yes. So we now have it being around about four
So
over
for
4%,
yeah.
in real terms. So, yeah, and that it has an implication. The implication is that the Monetary Policy Committee of the CBN most likely will meet in the month of May, and they'll be looking at much lower inflation rates to make decisions around interest rates in the economy.
So
This is
Tajudeen,
where the
you yes.
numbers
Sorry to interrupt you at this point
because
because I
they are
was
going to
yes.
cut interest rates.
Aha. You know why I'm interrupting you is that that's actually my next question in terms of the fight against inflation, the tightening, the aggressive, I must say, the aggressive monetary tightening cycle by the MPC of the central bank in the last, since Cardoso assumed office, 875 basis point tightening so far. So do you think with these prints now that we're getting, that the tightening cycle is over by the
Absolutely,
MPC? Especially
absolutely.
with the signal of leaving it on hold, rates on hold at the was it February meeting now? I think did they meet in January? I think it was
The
February.
February meeting,
Yes,
they left it, unchanged,
unchanged. Yes.
because I believe that they were waiting for, like the next 4 months for them to see what inflation will look like in the under the currently rebased consumer price index. And what we are seeing is disinflation in the economy. And what most likely will materialize in the month of May is that the Monetary Policy Authority will begin to cut interest rates because we are now seeing disinflation. When we look at the consumer price index, on a month-on-month, sorry, from a point-on-point, standpoint, and this is where the lower number is positive for the economy, because by the time they begin to cut interest rates, we most likely are going to see, number one, the borrowing cost, for the government being significantly lower, and that will also underpin the ability of the government to begin to think about, where else they can, utilize the savings, particularly if they can direct some of those savings, to productive, projects. Number two, and possibly more importantly, Nigerians will witness much lower interest rates. Small businesses, medium businesses, large businesses most likely are going to be seeing much lower interest rates on their borrowings, because the CBN would by then, go dovish. By dovish, we mean to cut interest rates, and they may also begin to allow a build up in what we call system liquidity, to ensure that the economy is able to recover much faster, by enjoying a more favorable environment, for growth compared to what we had last year. So this is where it is positive for the economy, and in the next couple of months after the month of May, Nigerians should be able to speak to their banks to negotiate lower interest rates, because by then the CBN would be adopting and implementing a dovish monetary policy stance on the back of lower year-on-year inflation rate numbers going forward.
How is the president's 15% target by year end looking likely? Are we going to hit that by year end? And how do you think that this inflation print also translates to growth?
So if we look at the president's target of 15% inflation rate, I think comfortably I can say that that number can be achieved if the current downtrend in the inflation rate that we are seeing is sustained. Currently at around 23%, what is just needed is a 1% continuous deceleration in that rate. We will land, at about 15% by the end of the year. And that, to my mind, also, if it materializes, is positive on the interest rate side. And that is what I believe, should be the joy of every Nigerian, because what it implies is that as inflation rate of 15%, then the monetary policy rate most likely would not be more than like 15 to 17%. It could be as low as that. And when if that is the case, businesses will be able to borrow for business expansion, for short-term needs or long-term needs, at a much lower interest rate. When you borrow at a much lower interest rate, it is even eventually positive for inflation outlook because higher interest rate is captured in the pricing of goods and services that Nigerian businesses do. But when you now have to pay lower interest rates, there is little or no push for you, the business owner, to want to increase the prices of your products and services. I think it is in some of these areas that the newly rebased CPI is critical for the Nigerian economy. The only downside risk to this is our currency, which is the exchange rate in this case, because the lower our interest rate goes, the more likely that our currency will, weaken, particularly if the United States, for instance, and other advanced economies are not adopting and implementing a dovish monetary policy stance. But if they are doing the same thing, cutting interest rates in their environment as well, then we are protected as a country in terms of the stability of our exchange rate. So it means that it is a win-win situation for us as a country if those two situations materialize.
Now, what do you see for these variables, exchange rates, fuel price, and food costs in the coming months? And we know that inflation sometimes is always a game that when things go up, they stay up and they hardly ever come down. So the question, I heard you clearly, of course, you said that perhaps in the next few months, Nigerians will begin to feel some kind of relief as to perhaps cooling prices going forward. But how do these variables which I've mentioned really translate to making inflation cool off in the coming months? And you're a strategy person as well as a research person. I think I also need to ask this in terms of what is the inflationary standpoint strategy, let me put it that way, for investment moving forward, especially for the big money spenders, whether in the markets, institutional investors, as well as the retail investors that are adopting the wait and see mode or to reposition themselves very quickly?
So I've been getting this question, for
Oh,
the past, few days now,
okay.
and I think the way Nigerians, should view the coming months is that the coming months, largely speaking, will be favorable in terms of interest rate direction, will be favorable to businesses, businesses that have products that they produce, businesses that create jobs for Nigerians, because we are likely going to see much lower interest rates. And, the much lower interest rate implies that, their profitability, will be a lot, better. And then there will be little or no incentive, for them to really begin to hike, prices. Nevertheless, it is not so good for portfolio investors. And I say not so good because having lower interest rates in the environment means that any money market investment by retail investors will be coming at lower interest rates or lower yield to them. Any investor will also see yield on their investments in the coming months. So those two elements, imply that if you are a portfolio investor as a Nigerian, you should be prepared to earn less on your investment in the coming months because we are heading into a period of lower interest rates given the picture that we are seeing with the rebased consumer price index. The question would then be, which of the two sets of investors should be favored? Should we favor the real sector investor? I'm talking about businesses that create jobs in this case, or we should favor the portfolio investors, who are there to make, earnings on the back of movements in economic indicators. I think for a well, balanced situation, the indicator or the decision to be made by the central bank and any other authority should be more favorable to the businesses that create jobs for in the economy, because
Okay.
when you have lower interest rates, you will be able to do more business on the back of that. And when we have more businesses springing up in the economy, we most likely are going to create jobs. When we create jobs, we most likely are going to grow the pension industry further, because job creation will create pension accounts, and then we'll begin to see, a
Okay.
better Nigeria. It may not be rapid, it may be gradual, and I think that is what we should look forward to seeing.
Okay. Okay, Tajudeen, I think let's make a deal. We could make a deal after the show for to have you back tomorrow, because I've not exhausted all of this, so that we can further break it down, perhaps with even slides and graphics. We actually even produced a lot of that today in terms of, we also take a look at the states, the most expensive states to live in, the less expensive states. We'll just do that. So let's make a deal, my friend, to have you on tomorrow. That's fine.
That's fine.
Thank you. I can depend on you as always. Thank you very much. I'll see you
Yes.
soon. All right.
All right.
That's Tajudeen Ibrahim, the Director of Research and Strategy at Chapel Hill Denham. Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms, where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.